Hello, listeners, and welcome to another episode of Cognitive Dissidence. As usual, I'm your host. I'm Jacob Shapiro. I'm a partner and the director of geopolitical analysis at Cognitive Investments. Rob and I are back at it for our weekly chat about markets and geopolitics. The only thing I'm going to tell you is that if you haven't reviewed the podcast or left a rating, please consider doing so. If you want to talk about CI research or CI wealth management and whether either of those things are right for you, email me at jacob@cognitive.investments. Otherwise, cheers and see you out there. Cognitive Investments LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Cognitive and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.cognitive.investments. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor.
Well, where should we begin in the world?
Let's begin. I like that we begin with markets, and last week we said was a key moment in markets. This week we're recording a little early this morning. It's before markets have opened. But what are you seeing out there, Rob? I see that NVIDIA is up 25%, but I think you're seeing something different than most of the headlines are going to have this week.
Yeah, it's funny because I think when people imagine professional investors, they think kind of we're sitting around constantly on our toes, watching everything, with 47 screens at all times. And it's really not like that at all. Most of the time, you're kind of just sitting around and waiting and watching, and things happen much more slowly because things develop slowly. But you tend to have these periods where something all comes to a head and there's a test, and it's going to tell you where the big things are going to move. And I think we just had one of those periods. Last week, we mentioned that we were really active and watching a lot of stuff. And what happened was, it's always hard to explain markets in a chart verbally, but if you had to summarize the last few years in a nutshell, then, we had this huge run in equity markets coming out of COVID. And beginning in early 2021, all of the bubble stocks and meme stocks and smaller cap stocks started to implode, and they've essentially been imploded since then. And then at the end of 2021, that's when the big stocks followed. So all of 2022, we were down, bear market, and we've been in this bear market since then. And, when the Chinese reopening story really started to get legs in the fall of 2022, last year, that's when you had this pretty significant bounce within that bear market. And that's kind of the story we've been living in since then, since last Thanksgiving. You've recovered some of the losses from that big bear, but you've sort of been in this trading range for the last 3 or 4 months. And if the bear market were going to continue, this would be the natural place for it to start again, for that rebound to fail and for things to start to roll over. And the reason why last week was so interesting was because, equities, the stock market in the US and in, European countries as well, were sort of at the top of that trading range. And they were breaking out all of a sudden. And I think last week we said, that's really weird because all of the other things that we're watching that move with the equities are moving in the other direction. So the euro is rolling over, bond yields are going up. Picture, a line of ducks all marching in the same direction, and all the ducks continue on and one of the ducks turns left, and you say, well, is that duck gonna keep on in that direction? And that the weird duck is the equity markets. So anyway, getting to the point, the duck did turn around and has joined the group in an awful hurry, and that's really important because we just had what I think you would call a failed breakout. And for those who are not really technically minded, what that means is that when markets have a very obvious level and they're sort of hitting resistance against that, and it looks like they're breaking above that level, people tend to get really excited and they get, they're ready to buy. And if it fails, if the breakout fails and it falls below that level again, it's a real psychological albatross, because it's like the bulls got punched in the gut, and that tends to follow, or tends to precede rather, very big moves in the opposite direction. And we just had a failed breakout in the US stock market, and that's a very, very big deal.
Yeah, well, I don't know. I mean, how does that square with, because I said 25%. NVIDIA is up 30% in pre-market trading this morning. I guess on this news about AI, and you've got AMD and TSM and some of these other semiconductor stocks are rallying in unison. Maybe it's just sort of a semiconductor week, but do you feel like maybe that boost upwards is in some ways the last gasp of what we're talking about here, or does that challenge the failed breakout thesis that you're presenting?
Well, I don't think it really challenges it, because again, the way, going back to our conversation 2 weeks ago, we talked about how we're so used to thinking like, if the economy is doing bad, then stocks do bad. And if the economy is doing well, then stocks do well. And that relationship is totally out of whack now, because what matters is inflation and interest rates, not economic growth. So we've been quite optimistic about the economy relative to everyone else, very optimistic, and optimistic about interest rates going up. And that's sort of playing out. What NVIDIA shows you is that there's areas of strong investment growth still, even, despite the fact that everyone is expecting a recession, everyone is sort of bearish on the economy overall. And that's in keeping, because what will kill the stock market is not, a recession. What's going to kill it is inflation and interest rates being too high, and profit margins by businesses getting squeezed.
Yeah, I also, it's funny to track the narrative with these things, because I don't exactly know how to benchmark what's happening around with the market conversation around artificial intelligence, because I feel like since we had 2020 and the collapse, there was the crypto moment, and then there was the metaverse moment, there was the meme stock moment too. You had all these sort of, oh, this is going to change the world, and then things would boom upwards, and then they would collapse in front of you. And I feel like we're doing that with AI right now. Like somehow in the last 2 months, everybody knows what ChatGPT is. Everybody's talking about artificial intelligence. Now artificial intelligence is the thing that is supporting all these narratives about stocks that are booming. And it's funny because artificial intelligence is the one that seems actually real to me on a 5, 10, 15-year time horizon, much realer than buying real estate in the metaverse or some of these things about crypto. But at the same time, some of these moves and the way that people are talking about artificial intelligence today, I mean, I'd be the first to tell you, I don't know anything about artificial intelligence. I'm spending most of my weeks right now furiously trying to read and get on top of these things so I can talk about it somewhat intelligently. And you see the people that are out there talking about it right now, nobody has any idea kind of what they're talking about. So I don't know, it almost feels like there's this little AI bubble that's hiding out in the context of everything else that we're talking about. I don't know if you have that same feeling.
Yeah, there definitely is. And we see that, remember, we're short sellers too. So one of the places where we're looking for shorts right now is in, bullshit AI announcements. Companies that are trying to cloak themselves with the aura of AI, but they're not really doing anything with AI, or they're going to get killed by AI. They're not going to benefit from AI. So Shutterstock is a great example of that we've talked about publicly quite a bit. They're screwed. And they're a company that's trying to give the impression that they're benefiting or they're harnessing AI. No. This is very bad for them and for a lot of other companies. But the AI thing is interesting because it is legitimate. It is huge. But it appears that it's going to be something that's going to be sort of broadly beneficial rather than something where one or two players captures all the rents. And that's very bad for the stock market, because if you look at Google, if you look at, Meta, if you look at Amazon, so much of the market cap in the US is based on companies that have built these, network effect moats and are capturing rents. And boy, you're seeing some real disruption here for the first time in a long time, and it's not certain how that's going to play out. And some of them will be fine, and some of them won't. But overall, relative to sort of the mid 2010s when it was, these companies competitively are unstoppable, and how will the giants sort of compete with each other on the margin a little bit, like these big empires, scuffling on the frontiers. But in the end, they're all just going to mint money, and it's just about how much. Like suddenly, that's much more uncertain. And ultimately, that's a really healthy thing, because what we're seeing, that's the other difference I would point out, is like a lot of the other stuff that we saw, like the meme stock bubble and things like that, like those were more traditional bubbles. Interest rates were really low, money was free, ridiculous schemes were getting funded. That's not the case now. If you look at other parts of venture, like those markets are imploding. Mm-hmm. That was essentially one of our big theses on Silicon Valley Bank when we recommended that our clients short it, is that cycle is turning. So the fact that you're seeing this great source of optimism and entrepreneurial activity rushing into this area, that's a real healthy sign. And there is bubble-like activity around it, but fundamentally, I think it's much more healthy than what we saw, a few years ago.
Well, let's move away from healthy economic developments and maybe pivot to unhealthy economic developments. Sorry, China, but let's talk a little bit about what's going on in the Chinese economy, because we've been kind of skeptical about the reopening narrative from the beginning. I would confess I was skeptical the reopening was even happening. I was a little late on realizing that the reopening was happening, but even when it happened, I was a little skeptical there. And it just, we have a few months here. I feel like the last remaining bulls were saying, "Oh, it's going to be Q2, Q3. That's summer. That's when it's really going to take off." But we're kind of running out of time here. And when you look at some of the data coming out of the Chinese economy, not looking particularly good. What are you seeing on your end?
Well, I think it's no secret that the growth in China and the rebound coming out of reopening has been disappointing. The narrative is shifting now. Before, it was more uncertain. Is it going to explode? Is it going to disappoint? Now, it seems like the consensus is, okay, it's going to be disappointing, but now they're going to do stimulus. Like I saw on Bloomberg, the CEO of, I think, Ivanhoe Mines was out there today saying, hey, copper prices are collapsing and people are really negative on Chinese demand growth. But we think in the second half of the year, there's going to be more stimulus in China, and that's going to, So if they're already talking about them having to sort of save the rebound, that's a pretty disappointing environment to be in. And the way to think about this is you always look at markets to tell you where things are going. Even in China, where the markets can be a little wacky. And when I look at markets, I see Chinese bond yields coming down as sort of deflation is priced in. I see 3-month interbank rates in Shanghai hitting a 6-month low as things slacken. I see junk bonds in China, which I think I've talked about like every week for a month. Junk bonds in China are now down 20% from their peak. That's a really big deal. So all of those market measures are showing us that Chinese growth is really coming off the boil again, and this it's stumbling out of the gate here.
It is stumbling out of the gate, but I think there's two aspects that I would add to this, which is it really depends on your perception. Like, so if you thought it was going to be 2009, 2010, gangbusters, take out the bazooka, pre-Xi Jinping policies, then yes, it is pretty disappointing. But we've talked about the inventory cycle. Trade data has been sort of mixed with China. You'd have months where it surprises to the upside, months where it seems to be a little bit lower. But I think CEOs like the one you mentioned, who were thinking, oh, there's going to be more stimulus in the second of the year. That to me sounds like fighting the previous battle or fighting the previous war, to steal a metaphor that you like to use a lot of the time. And I think that we're just not paying enough attention to what the Chinese government is doing, because I find them to be relatively transparent and clear about what they're doing. First, they came for the tech companies. Then they came for the property developers, and now they're coming for local governments that engorge themselves on debt and things like that. And I wonder if some of the behavior that you're seeing in bonds in China is because people are maybe just starting to get the sense of, ooh, maybe China's not going to bail out some of these local governments, or maybe they're going to make it a little bit harder for them to sort of get from point A to point B with this if they are over leveraged. They're not just going to let them do business as usual. And you and I can argue with Pettis and whether they're going to be successful or not. But I think China is trying to change some things fundamentally with the economy rather than just go back to growth with and all the sort of old ways that they would stimulate economic growth. And I think that might be the story for the second half of the year. I expect that same sort of narrative we had with China Tech, which China Tech starting to rise up a little bit, right? And we hold a little bit of Tencent in one of our strategies. Property developers hasn't been as bad as most people thought. They've been able to muddle through. I think local government debt might be the big story at China the second half of the year. And the market narrative there is just, everybody hates China. China's still, quote unquote, uninvestable.
Yeah. Have you seen anything specifically on local government stuff as far as their relationship with the regime? I didn't notice that on the knowledge platform.
I put a few in just this morning, and I have another one that I have to put in. It's nothing quite direct yet, but there's sort of a small smattering of stories that are start to coming out about smaller Chinese provinces that have too much debt or are over leveraged, and what is the government going to do about them? And some of them are from sources like the Wall Street Journal, who have their own yarn that they're trying to spin there. But some of them are Chinese local media that are talking about, oh, well, this province built, I forget which province it was, but it built how many bridges over the course of the past 10 years. They don't need 1,800 bridges. They probably just needed 15 bridges, and they're over leveraged now and trying to think about it. So there are little whispers there, but no, there has been nothing quite direct yet. And I think you're right that if I'm right about this thesis, you're going to get that direct moment, because Xi Jinping had that meeting, I think it was summer 2020, where he brought the tech companies in and said, you will participate in China's social stability, or you will find yourself on the opposite end of the Chinese government. And some of them didn't listen. Jack Ma was one of them who didn't listen. And then you had the crackdown. Same with the property developers. They came out and said in 2018, hey, here are the red lines. We're not going to bail you out if you go past the red lines. And that's when you got, Evergrande went past the red lines, got in trouble, and Xi Jinping wasn't going to hold the bag. So I don't think we've had that crystallized moment yet, but it's out there in the weeds a little bit if you look closely enough about that being a concern going forward.
Well, I think that's the most important thing to watch in this whole scenario, because the local governments will be their most formidable opponent, but also their most important area to attack. Because if they can reform local government sort of overinvestment and wasteful spending, then that's a huge change in the model. But it's going to take, there's going to be blood in the streets.
Well, the other part of this, and this I did already put this on the knowledge platform, which is, and it's hard with Chinese data, but unemployment data in China is also not looking particularly good. One of the stats that stuck out to me this week was that 20.4% of people 16 to 24 looking for a job were out of a job last month in April. 16 to 24, that's fairly young. But when you start reading some of the anecdotal data, this actually was sort of comforting to me from a universalist perspective. You've got all these millions of Chinese college graduates who want jobs in tech and biomedicine and all the things that everybody wants their kids to go in for, and they can't find jobs. They're none of the jobs for the things that they've actually been trained in, but if they wanted to go work in things like tourism or logistics management or freight cargo, plenty of jobs in China for that. So just as in the United States, we're having this mismatch between, we've trained a college force to do one thing, and yet we can't get people to actually rip roofs off when a hurricane comes through or install copper pipes and things like that. China sort of has the same issue too. Has the same issue there too. The problem is just that the Chinese system is not flexible enough, or at least it hasn't shown itself to be flexible enough too. So if you have all these bubbles that you're trying to pop in the Chinese economy, and you have young people who are not feeling particularly optimistic about the future, it is a combustible combination.
I guess it begs the question of what they might do if they start to really worry about unemployment, because we've talked about the inventory cycle a lot here, and you just mentioned, the inventory cycle in the U.S. Appears to be bottoming. Whether it's going to rebound is sort of the question du jour. But the U.S. corporate sector has stopped shedding inventories. So like if you look at companies like Target and Walmart, what they're saying on their calls, like the inventory reduction is over. Now the question is, will they be comfortable enough about the US consumer to build inventories again? And why does that matter for China? It matters for China because Chinese factories are sitting around twiddling their thumbs. And you're starting to have an unemployment problem, and you're starting to have a human capital sort of depreciation problem. So there was a piece on Digitimes Asia that I put on the Knowledge platform a week or two ago that was pointing out that you're starting to see some of these electronics manufacturers in southeastern China, Guangdong province, they're going out of business, and their workers are dispersing because conditions have just been so depressed for such an extended period of time. And that's a really big deal because that's the heart of the Chinese export sector. And if you look at those areas where, there's kind of local areas of specialty knowledge, how to build very specific things, it's not just electronics, but, umbrellas and shoes and just random stuff like we've talked about in the past. That's a major problem, a major problem. And you have to think that the Xi regime is worrying about this.
Well, that's true, and we've got anecdotes like that. But if you actually look, like migration laborers in China are actually doing okay. It's really like they're not the ones where the unemployment data is showing that there's problems. It's in those college-educated Chinese, young people who are really having trouble finding jobs. Yes, there are parts of the export model where China's losing market share for sure, but some of this is PR. Some of these U.S. companies that are announcing that they're moving to India or some of these other places, really what they're doing is they're taking some components that they're still making in China and then moving them over to India or someplace like that in assembly. So like maybe you're losing some jobs there in the wash, but you're not actually decoupling or nearshoring. This is a much more difficult process. It's not going to just happen sort of in a year or two. So I think there's still demand for migrant laborers and those factory workers in China from that perspective. You also see, though, China moving into different areas. I mean, you probably saw this thing about how China automakers are exporting cars at record clips, and they're becoming the dominant EV car maker in the world. So they're having to pivot. They're probably having to retrain forces and like that. But I think the migrant laborers and the factory workers, those are in some ways the easy problem, because there's always going to be a market for Chinese laborers to make things to export abroad. I shouldn't say always. There's enough demand globally, and we haven't gotten far enough down the deglobalization rabbit hole yet, where I'm really particularly worried about those migrant laborers over the next 2 to 3 years. What worries me more is if you've got 12, 15, 20 million Chinese college graduates who are coming to the workforce every year, and there's nothing for them to do. And then they're sitting there twiddling on their thumbs, and they've read a bunch. They're technologically savvy. They were expecting something better in the world. It's when you get those sort of middle class folks who are, those are the ones that usually can enunciate the ideology that maybe pulls some of the migrant laborers when those jobs start drying up, when deglobalization really visits itself on the Chinese economy. And then, at the geopolitical level, amidst all of this, you've got the Biden White House talking about a quote unquote thaw in relations between Beijing and Washington, which, I said this last week, I'll say it again. The horse is already bolted from the barn, like Biden's chasing the horse in the middle of the pasture, and the horse is not coming back. But, the United States is apparently really thinking it can have this kind of thaw with China while it fast tracks weapons to Taiwan and signs trade agreements with Taiwan and adds more Chinese companies to the entity list. Amidst all of that, there's also those top level machinations happening as well.
Yeah, it's a multifaceted problem because those are very different markets. On the manufacturing and the migrant labor side, though, I don't think it's deglobalization that's the issue, because that's, as you point out, that's not really happened at all in any meaningful way yet. It's simply the depth of the cycle and getting finance to survive. That's sort of what I mean is China had terrible luck because they were shut down while the US was booming. And when they opened up, that's when the US was trying to dump all the inventory that they could, and they weren't ordering anything. So you basically have had almost 2 years where you've seen really depressed conditions in the export manufacturing sector. And that's, problematic just because these companies run out of money and they don't have access to good formal finance. There's not, these aren't publicly traded companies where you can raise equity on the markets. Like a lot of these are informally financed family networks. And the problem is like the workers will always be there, but once the businesses go under, it's not easy to just restart that stuff. So they're facing challenges on a lot of fronts right now.
Yeah, no, they absolutely are. And the last thing I'll say about this before I know we want to talk about Hong Kong too, but I've noticed this lately, which is, I did a bunch of podcast interviews on other podcasts this week, investment themed podcasts and things like that. The question I get most frequently from sort of that group is China going to invade Taiwan? And then I have to do my whole China-Taiwan dog and pony show. I won't do it for you now. But companies that we work with via CI Perch and who are, actually using these insights for supply chains and for, thinking about capital expenditures over the next 3 to 5 years, they haven't mentioned Taiwan in months. They want to know what's happening with this, with the China Cyberspace Affairs Commission going after Micron Technology and saying that Micron Technology's equipment failed the network security review, and so Micron Technology will no longer be able to sell in certain Chinese markets, and they're going to put lots of onerous restrictions on them in general. And that goes to this, the deglobalization myth we're talking about. I'm a herald of deglobalization, and let me tell you right now, it hasn't really happened at all. And China wants to keep a lot of these U.S. companies in China because they need the jobs, they need the tech transfer, they need everything else. And they're searching for examples like Micron to try and push back against the United States to show that they have any leverage whatsoever. But in the U.S., you've got the White House, which is sort of in its own policy world about, is it a Cold War? Is it not a Cold War? Is it a thaw? Are we going to push back? Whereas U.S. companies are scared shitless about this Micron story and are wondering, are we going to be next? Is NVIDIA going to be next? Is AMD going to be next? Or some of these companies going to be the next ones that the China Cyberspace Affair Commission brings in and says, you may no longer access the Chinese market either. So just to say, there's this weird juxtaposition between what media and markets and investors, I think, are talking about and are worried about, and what I feel like actual companies are worried about, because the decoupling thing and the deglobalization things that are happening, when those things actually do happen, it's going to be extremely disruptive.
Yeah, which is a nice segue to Hong Kong, I think, because that was the gateway for these companies for so many years, and now things are changing.
Yeah, I mean, things are changing in a big way. It's funny, I was talking to a Romanian friend of mine this week, and we were talking about Hong Kong as well. And I mean, I've talked a little bit about Hong Kong on this podcast, but we can go into a little bit. I mean, one of the reasons that Hong Kong, as you mentioned, was so successful was because it was this English-speaking British legal system gateway into the Chinese market during the 1970s, 80s, even into the 1990s before the handover. I've always the metaphor I like to use is, Mos Eisley on Tatooine. It's the bar where everybody's hanging out, all the weird deals are happening, like lots of culture, great food. It was sort of the place to be. And the thing about the and it didn't really happen with the handover, but when China basically got rid of one country, two systems, and then you had the Trump administration got rid of preferential U.S. policies for Hong Kong. I think that was in 2020, or maybe it was 2021. I'm forgetting exactly. It must have been 2020, right? Because 2021 was not Trump land. Anyway, Hong Kong was done at that point. Like, there was going to be no Hong Kong anymore. And the question is, what are going to be the next financial centers that pick up that mantle? And, I've always thought Singapore was the obvious answer, and that's reflected in our strategic wealth strategy right now. My Romanian friend I was talking to was like, Singapore is nice, but honestly, like, that's sort of old news, Jacob. You should really be thinking about Dubai, because Dubai is like making this play to try and become that center. I think there are other places around the world that maybe can try and vie for that status. But, Hong Kong has gone from, interesting gateway into a forbidden market to just another sort of Chinese market with a lot of inertia and a lot of old baggage. And that baggage is going to have to be unwound. I think, unfortunately, that's the geopolitical take.
Yeah. And if you look at markets, that's an interesting story. And I think I said to you before we started recording, because we were talking about this, that they have a plumbing problem in Hong Kong, and how they resolve this is going to be really interesting to see, because, the geopolitics might have changed around Hong Kong, but it's not so easy to get out of these legacy financial structures that have been erected in an older time. So what is Hong Kong doing right now? I mean, first, you can see this in the equity markets. So the Hong Kong index, the HSI, just hit a 6-month low, and it's really flirting with a very important level that's tended to be support over the last 15, 20 years. And if you were to visualize this, what I mean is it's floating around at the bottom of the chart, and it's breaking through a very key support to show that sort of the floor might be falling out in Hong Kong, at least on the equity side. There were 2 IPOs in Hong Kong this week. Both of them were busted immediately, down 30, 40% out of the gate. Just very unhealthy price action in those equity markets. And then in interest rate markets, you have this really interesting situation because, of course, the Hong Kong dollar is pegged to the US dollar at 7.75 with a range. And that's a real dilemma now because, as we've said on multiple occasions, one of the big themes in a multipolar world like the one we're in now is that economic cycles and interest rate cycles in the major regions of the world are moving in different ways. The tectonic plates are all shifting in different directions. And Hong Kong is sort of at the hinge of one of those because, as we mentioned, the Chinese economy has been in the doldrums and has been slowing down again. And Chinese SHIBOR, Shanghai Interbank Offered Rate, so bank rates in Shanghai, are only 2.24%, and they're going down. They're falling as more slack grows in the system and things slow down. So 2.24%. The interbank rates in Hong Kong, just down the road, so to speak, are 4.63%, and they're not going down, they're going up. And the reason is because Hong Kong rates are tied to US rates, because otherwise you can't maintain the peg. So they have some really hard choices ahead of them. They either have to endure, constant sort of volatility in the economy of Hong Kong or downright recessions in the economy of Hong Kong because they're just clamping on the monetary brakes to keep the peg in place. Or they have to give up on using Hong Kong as a conduit to the mainland Chinese economy. But right now, it's really hard not to do that. Like if you look at how they're trying to bring capital into the onshore Chinese bond markets, most of that capital is coming through Hong Kong, through this Hong Kong Connect program. So it seems premature to abandon what they've established in Hong Kong, but boy, are they in a pickle.
Well, and this comes down to timing because there are a few zealots out there about the Hong Kong dollar who were just waiting for the Hong Kong dollar peg to collapse. I think we talked about the Hong Kong dollar maybe a year ago, and our conversation means I should probably throw out our previous take and go back at it. But my off-the-cuff podcast answer would be that I think that's probably too much disruption for both China and Hong Kong to tolerate now. I think you'd have to see a much bigger break, bigger than even the one we've already seen between the United States and China, for China to be willing to do that. But I also take your point, like, what is the advantage now of actually going to the Hong Kong stock market? Like, if you want to own a Chinese stock, you should probably own it on the Shanghai Stock Exchange. If you have the bravery to own Chinese stocks directly that way, you get no real benefit with Hong Kong, especially, we talked last week about the yuan weakening as well, which is part of this whole mess and which puts even more pressure on it. So it's just a timing thing. And I know that there are, investors out there who have very loudly talked about the Hong Kong dollar peg, and if and when it fails, they'll be the first to say, we were doing it. But I don't know, I just want to temper what we're saying a little bit because, correct me if I'm wrong, I don't think you're saying that peg is in danger anytime now. It seems to me this is the slow drip, drip, drip that eventually will probably change things from China's perspective. But I don't think today you see anything but, Hong Kong and China's willingness to defend the peg and defend its status right now. But maybe I'm reading you wrong. Is that a fair statement?
No, that's totally fair. And I don't think that that's a very interesting or good trade to try to short the Hong Kong dollar. trying to short these pegged currencies is so fraught with historical memory, because there's so many people who remember the Asian financial crisis and how the Thai baht broke, and George Soros made $1 billion shorting the Malaysian ringgit and all this stuff in the late 1990s. That's not going to happen again. And this is such a weird, unique case. Hong Kong is so small relative to the Chinese economy. China has a currency that has its own problems and, is not an international currency and all the things that we've talked about and others have. But this is not some, pissant third world country dependent on flows coming in from the US, and they're, trying to keep this peg up to show a face of stability. It's not even remotely like previous cases. And I think there's a lot of dumb theses out there of people saying, oh, they're going to be forced. Maybe they'll choose to at some point, but I think if they do, it'll be sort of a backdoor slow thing. And more likely, they'll just downgrade the importance of the Hong Kong dollar in any way that they can. They'll try to encourage use of the yuan more broadly in Hong Kong and, make that transition over time. The play here is not to get some big short. It's not interesting. It's really more of a geopolitical longer term, how are they going to manage this situation? And what do those choices say about how they're planning to engage with the West,
Well, yeah, and this is another perfect segue here, because for me, the geopolitical story, or at least in this context, there's also a China element, but it's also about what are going to be the next financial centers of this multipolar, deglobalized era. What are the city-states that are really going to matter from that point of view? And it's probably not going to be Hong Kong, and it's probably not going to be London, which has had a really big position here. It's probably going to be, it can be a Dubai, a Singapore. I think Istanbul has, we'd have to see, I'd have to get right about my normalization thesis there, which, by the way, I've had a couple Turks reach out to me and tell me I'm absolutely bonkers for thinking that there's going to be any change in Turkish monetary policy. But that's a good place to be. When people tell me I'm absolutely insane, that usually means I'm onto something. But we can go down that rabbit hole next week after we have election results from over the weekend. The pivot here is supposed to be to talking about the UK, which, Brexit happened. I think time has smushed together. Was the vote 2015, 2016? Then we had years of interminable negotiations. I'm sure there are still negotiations going on anyway, but I think we're starting to see the delayed return on what Brexit is doing to the British economy, because the British economy is going through what every economy is going through with inflation and demographics. But then on top of that, they ruptured their trade relations with, in some ways, their most important trading partner, and I think that's sort of fixing into it too. But I'll let you riff there, because I know you were seeing some data out of the UK that was particularly concerning.
Yeah, that's right. And this probably got lost in the some of the other news this week. But really, two data points on the UK that I think encapsulate a lot of what's going on right now. The first one was the inflation data came out yesterday, and this got a lot of attention, actually. But essentially, what happened was inflation in the UK accelerated way beyond what was expected. So on a month-over-month basis, the CPI was up 1.2%, and it was expected to be 0.7%. Which doesn't sound like a big difference, but that's a huge difference when you annualize that.
That's yikes.
Yeah. And it's even more of a concerning story if you dive into the numbers, because the core inflation, which strips out energy and strips out food and sort of the more volatile components, accelerated to 6.8% year over year, which is actually a new high. So core inflation is hitting new highs in the UK right now. I mean, just imagine that and compare it to the rest of the developed world. What an outlier, right? And another thing that is a little weird, and I struggle to understand exactly what could be going on because it doesn't match what you're seeing elsewhere, is food, alcohol, and tobacco was up 2.0% month over month, which is the highest month over month increase that I can see going back at least a decade, probably ever. That's really really, really shocking. And all of that is bad.
Yeah, no, there's a lot of. I'm pausing here because I'm looking at opinion polling for the next UK general election, and the thing I want to point out here is that obviously you had a huge drop in support for the Conservative Party around the failed premiership of Liz Truss, and you and I were both lucky enough to be in Ireland for a few days for at least. It was probably a fairly large percentage of however long she was prime minister that we were in Ireland, getting to hear the Irish talk about, with their wit, talking about Liz Truss as Britain's prime minister. Rishi Sunak seems to, or at least he stabilized things for a while, but that's also begun to turn here in the last month. And if you look at opinion polling right now, I mean, Labour Party's polling at, this is 47% at this Delta poll. You've got 42%, 42%, 46% from some other recent polls against 30, 29, and 30 for the Conservative Party. So I guess what I would just put in mind there is that, Britain is going to have elections soon. And if things keep up with the mismanagement the Conservative Party has overseen now for a period of years, I wonder what a Labour Party government, just how sort of aggressive they can be in changing policy. I wonder even if they can reopen that Brexit debate, or if the UK would even ever consider going back on joining the European Union. I'm sure none of us want to be dealing with the Brexit debate again, but crazier things have happened. If the UK economy continues to shit the bed and the EU economy is sitting there as an opportunity, I don't know. I just think nothing is irreversible from that point of view. But in general, the point just there is I'm not sure that we're going to be in conservative-led Britain for that much longer, and it'll be interesting to see what, if anything, the Labour Party does to try and turn the ship around.
Well, they're going to have a very hard task ahead of them. Because just from a macro standpoint, things appear to be going from bad to worse. The other data point that I thought was interesting, just in the bigger picture, is the UK released its monthly federal debt, the public debt numbers this week, and you actually saw government debt accelerate, which was very strange and very much against the grain of what you're seeing elsewhere. So growth in government debt is accelerating and is now up to 100% of GDP, which is weird because you saw a huge acceleration in government debt. I think government debt went from about 85% of GDP pre-COVID to 100% now. But every country had that big bolus of debt growth after COVID, because of stimulus programs and the like. But most of them have been, seeing their deficits shrink dramatically, after that, especially as, you had a economic rebound and that sort of thing. And again, the UK saw some deceleration in the growth of its debt. And now that growth rate is accelerating again. That's really concerning. And the overall levels are not at such an alarming level yet. So it's 100% of GDP. To put that into context, the US is 130% of GDP. But for the UK, they're not the EU, they're not the US. They're a small country now, and that's, for a small country, that's a little worrisome. It starts to get concerning, especially if there's no obvious out. And these other measures show things seemingly getting worse, Yeah,
the geopolitics have changed fundamentally for the UK, and they either have to change or they're going to be overtaken. And the great comparison case here is Ireland. And we recently put out, a piece on the Knowledge platform about why we think Ireland's a big geopolitical opportunity, and we can talk about some of the bigger stuff there. But I would just say, you can be a small country and still be fabulously successful in this world, but it comes with a different sort of geopolitical logic. You can't be the sun never sets in the British Empire, and we are, you can't sort of rest on your laurels there. You have to do what a Singapore, what a Qatar, what an Ireland is doing if you want to function as that powerful smaller state. And that's exactly what Ireland has been doing. And with the UK choosing Brexit and choosing to say, okay, we're not going to be this English speaking island removed from the European continent, but with access to the European continent, Ireland can sort of slip itself in there and be that gateway between the European Union and the English-speaking world. And you're getting really interesting signals out of Ireland that they're thinking about how to position themselves accordingly. They've already become a global tax haven. Can they take that next step to becoming a center of global finance and actually keeping some of those flows and, building the Irish economy on top of that? They have some tough decisions as well ahead of them. I don't know if you saw this on the Knowledge platform, but Ireland is now debating its policy on military neutrality. So Ireland, despite being a quote-unquote English-speaking country, has never been part of the Five Eyes. Sort of skeptical always of U.S. and British-led security alliances. Britain didn't trust Ireland in some sense in World War II because of strange relations between Ireland. We can go down the sort of historical rabbit hole, but you see Ireland now wrestling with that too, because they want to be part of that Western alliance, but they still want to be the pragmatic character that can be open to the EU and maybe even open to China and things like that. So, but that's the place you want to be. You want to have options. You want to be pragmatic. You want to be the place where, you have business here. We'll figure out how to make business work for you. And that's where Ireland is right now in its cycle.
The other piece of news I found really striking was this announcement that they're creating a sovereign wealth fund. Did you see that?
I did not see that, but that makes sense.
I mean, that's a pretty rarefied group of countries that are in a position to do so. Do you want to talk about some of the geopolitical points in the In Focus report that we published for our research clients on Ireland, or at least briefly, because it's kind of an interesting thing to skim over?
Absolutely. Although first, I'm just googling which countries have sovereign wealth funds. It's there are more countries on this list than you might think. I guess we should look at successful sovereign wealth funds. Obviously, I feel like Norway is the one that gets the most press about being successful, but I also had it in my mind that Libya had a sovereign wealth fund too. So it's sort of all flavors there. But no, when we go back to the geopolitics of Ireland, as I said in the In Focus piece, this was a fun bit of research to do, because oftentimes with geopolitics, not a lot changes. You're trying to figure out geography and macro forces and fundamentals that aren't changing, and Ireland is changing. And I think you can make the case that for the first time in over a millennium, and I'm not exaggerating here, I can make that case with a straight face, Irish geopolitics are good. Things are going their direction. Geographically, Ireland developed the way that it did because it just wasn't conducive to having a sort of unified country. Had all these various kingdoms and tribes fighting back and forth, and that made them very susceptible to foreign conquest. First it was the Vikings, then it was the Brits. The English came in there and did horrible things to Ireland. Ireland is still bearing the scars of, and for hundreds of years that's what Ireland was. Ireland was a colony of sort of other countries that were around it. Ireland is still not whole. I mean, Northern Ireland is still sitting there and is part of the United Kingdom, and that is some of the inheritance of this awful period. The Chinese talk about the century of humiliation. The Irish can talk about the millennium of humiliation if they want to, but it's all starting to change. Ireland is seen in some ways as the more level-headed actor when it's compared to Great Britain. They are no longer susceptible to foreign invasion or conquest from abroad. They finally have in the European Union a block of countries that is stronger than its potential rival, and the UK isn't going to be invading Ireland anytime soon anyway. If anything, it looks like British policy doesn't want to be dealing with Northern Ireland anymore. It seems like more of a headache than anything else for the British political establishment. So you just sort of, at that very, very macro level, Ireland has agency and security in its sovereignty that it's really never had before. And I think you can see that the Irish would be the first to tell you that they have problems. If you talk to people in any country, they'll tell you that their political problems are completely intractable and unsolvable and everything sucks. But when you just sort of look at that macro perspective, the world is changing in such a way that should be good for Ireland going forward.
I was rereading Ulysses just this morning, speaking of Ireland, and James Joyce is probably the prototypical. He would have been great in this environment. An Irish guy, speaks multiple languages, living in Switzerland, mingling with the international crowd. I mean, that's what Ireland basically can become within the EU, right?
I'm impressed. I'm impressed that you can read James Joyce for fun. I've always found him to be a bit of a slog, personally.
No, you got to read Ulysses. The rest of it, Finnegan's Wake is unreadable. Ulysses is great if you sit down and put your mind to it.
I still have PTSD from having to read Portrait of the Artist of the Young Man in high school. I sort of said never again after I had to, what was that? That was 200 of the longest pages I ever read in my entire life. I remember absolutely nothing of it except the pain of having to read it.
But on the sovereign wealth thing, it's funny you mentioned there's a lot of countries that have them, but I would wonder how many of those countries that have them for non-natural resource reasons. Because Norway, the sovereign states, it's all oil trust funds, and they create these things so that you don't go and spend it all of your export earnings, because it creates economic imbalances that are hard to deal with. Ireland, if they create one, it would be because of the windfall from corporate taxation on multinational companies who want to be in there to, be rooted in the EU and because of all the, tax benefits and stuff like that. That's a fairly unique situation to be in. Maybe not sustainable at this level for the long term, but still an interesting advantage relative to what you usually see.
Well, I'd have to interrogate this list a little bit more, but there actually is. It's funny, they divide between origin as oil and gas based or non-commodity based, and the only ones that have real scale that are non-commodity based are Singapore, China, France, South Korea, Canada, and Hong Kong. And then you get beyond that, and it starts to get small and sort of more based on commodities. So
I'm sorry, France has a sovereign wealth fund. Don't tell don't tell the people who are rioting in the streets for their pensions.
Yeah, it says, I mean, it looks like, we can get into that later. I'm going to go down that rabbit hole and come back with some more research probably next week on that. But yeah.
All this talk of Ireland and the EU reminds me, I used to, when I studied for a year at Oxford, which I know you did as well, I had an Irish tutor, and he told me at this time that, because he knew a lot about the EU and what was going on, he said, one of the problems for the Irish is everything they do in the EU is about England and trying to position themselves as the anti-England, cozying up with the French, cozying up with everyone else, sort of. Everything was like, the English, delegates are over there. We're going to sit on this side of the room, that kind of thing. and it's kind of an interesting opportunity for them to not define themselves in that way. And that's sort of a slightly outdated view. And I think things have changed as Ireland has become more confident with the years. But not only to be the only English-speaking gateway to the EU, but also, to have the English albatross off their back, just in terms of how do they explain their positions, how do they define their role. Could be a subtle but important point.
Yeah, and it's also just an important. We talk often here about emerging market economies and talking about Brazil and Indonesia and India and the pros and cons and things like that. And I also think that this is a very interesting geopolitical line of thought too, which is what are the small countries? What are the city-states? What are the financial centers that can also take advantage of these opportunities as well? Because, if we were in the 1400s and the 1500s, it's Venice that you would want to be exposed to probably, because they were the ones that were in the right position. So it's not always just at the country level. Just because we're having this big era of great power competition doesn't mean that there's not opportunities for smaller countries there. You can't be a small country and behave like a big country, which is unfortunately the space that the United Kingdom is occupying right now. Well, that's a lot, Rob. Is there anything else you want to talk to the listeners about before we get out of here?
No, I don't think so. We'll end on the Irish note.
Yep. So thanks, listeners, as always, and we'll see you next week, Rob.
See ya.
Thank you so much for listening to the Cognitive Dissidence podcast, brought to you by Cognitive Investments. If you are interested in learning more about cognitive investments, you can check us out online at cognitive.investments. That's cognitive.investments. You can also write to me directly if you want at jacob@cognitive.investments. Cheers, and we'll see you out there. The views expressed in this commentary are subject to change based on market and other conditions. This podcast may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur.